In this week's video, we'll review the latest charts and data to help us answer the question, how concerning is the damage to the stock market? These are the bullet points that we used in the closing segment of last week's video. Probably fair to say all of them still apply, and this about sums up Friday's session, rate-induced volatility. As we've mentioned numerous times, probably not going away anytime soon. Short-term momentum still vulnerable, more downside or pain still possible. Primary trend, as you'll see in all the charts that follow, still unequivocally up. Chart in the left center portion of your screen is a daily DeMark chart. DeMark charts are proprietary tools from Market Studies LLC. S&P finished down on the daily chart 54 points on Friday. This is during the session. The next bull-bear reference point sits around 44.05, the close on Friday, right around 44.50-ish. Daily DeMark count sits on a 9.11, telling us should be aware that a 9.13 could be flashed soon. It's also good to know Friday's session had a massive options expiration. From Bloomberg, piles of derivatives contracts tied to stocks, index options, and futures are expiring Friday. Covered JNKIEF later in the video. The weekly chart finished up 0.53%. XLP relative to SPY weekly, this is what the ratio looked like as of the close on Friday. With this look, and this look, all of the commentary that follows still applies. In terms of interest rates, we still have the 913 count in force on IEF. Similar count was in play October 2022. It's also noteworthy that rates really didn't start to move until several weeks after the 913 was flashed. Not a prediction in any shape, form, or fashion, just something to be aware of. At a big down day on Friday, the VIX still finished red for the week. It was down 0.36%. It also finished the week below 14, a topic we'll cover in detail later in the video. Also noteworthy, Fed expectations have been improving. Market expectations that the Fed will skip in September and November, leaving rates unchanged. 68.5% late on Friday. On Thursday, it was at 63%. A week ago, significantly lower at 53%. A month ago, 61%. And after the close, it stood at 73%. There has been a little bit of a shift in Fed expectations, and if anything, it's been in the market's favor in recent days. S&P 500 weekly. This is the look during Friday's session on September 15th. You can pause your video player and draw your own conclusions. Cover this numerous times. You can find more about it if you Google this title here. This rollover look is the look we want to avoid. This is the look, upper right-hand corner of your screen, of the exact same ratio, weekly chart on Friday, September 15th. Every chart on your screen, September 15th at approximately 2 to 2:15 p.m. Eastern Time. Upper left-hand corner, all of this volatility is occurring well above an upward-sloping 200-week moving average that sits around 3,900, meaning you could see a lot of give back in this direction. It really wouldn't be doing any significant damage to the secular bull case. This chart is covered in detail later in the video. This is what it looked like on Friday. And as we've covered in the past, it's quite possible that the market will decide to come back and fill this gap around 4,200, around the same vicinity as an upward sloping 200-day moving average. This speaks to an uptrend. This speaks to an uptrend. This speaks to an uptrend. And this speaks to a favorable trend for risk. Is all of it subject to change? Absolutely, positively, yes. But we can make confident statements about the charts in front of us as long as we're willing to wake up with a flexible, unbiased, and open mind on Monday. Before we review charts from the September 11th to September 15th trading week, let's review the concept of a secular trend. The charts that we're going to cover in this segment can be found In this post on our blog, Short Takes, you can Google the title along with our last name. Keeping in mind that charts are a reflection of human behavior during a secular trend, a secular bull market. Buyers tend to step in near an upward sloping 200-week moving average in blue that occurred in 1953, 1958, 1962, and 1966, which is in stark contrast to human behavior during periods of secular stagnation. Market made little to no progress between 1968 and 1978, and instead of buying conviction picking up near an upward sloping 200-week moving average, price tended to slash right through it in a concerning manner. Since we know the longer a market goes sideways, the bigger the move that we can expect to get. We either get a bullish breakout or a bearish breakdown. It's not particularly surprising that this period of secular stagnation in the lower left-hand corner of your screen was followed by another secular bull, with price making a stand near an upward sloping 200-week moving average in 1984, 1987, 1990, 1994, and well above an upward sloping 200-week in 1998. So from a pattern recognition standpoint, probably fair to say that this period here in the middle of your screen and this period here in the upper left-hand corner of your screen look discernibly different relative to this period in the lower left-hand corner of your screen and the period in the lower center portion of your screen. Similar to the tepid conviction between 1968 into the end of 1979, buyers really didn't have a big interest in stepping up near the upward sloping 200-week in 2001, and price for the most part bounced and then slashed right through it in 2008. And once again, following this long-term period of consolidation, the market's character started to change in 2011 when buyers did step in near the 200-week, a downward sloping 200-week, telling us that this trend still had some work to do. And eventually the market exceeded these highs here, and a new secular bull was underway, with price making a stand at an upward sloping 200-week in 2016 and 2018. Probably fair to say this looks a lot more like this and this relative to this and this. Thus the million-dollar question is, how does the exact same chart look today? It a short stay below an upward sloping 200-week moving average in COVID 2020. And in Q4 of last year, we bounced in a textbook manner, with buying conviction picking up, institutional buyers stepping in near an upward sloping 200-week. It's probably fair to say the pattern in the lower right-hand corner of your screen looks more like the patterns in the top portion of your screen relative to this pattern and this pattern, which of course speaks to patterns of human behavior. A chart of the 10-year yield still holding that long-term breakout that we've been talking about. And walking forward, as we think about two extremely important topics, the Fed and interest rates, we should keep in mind where we've come from. In the rearview mirror, a period of ultra easy monetary and fiscal policy that featured numerous macro trends that tended to drive down long-term inflation, with the mindset in 2019 that inflation really wasn't something that we had to be worrying about. Negative interest rates and ultra-low interest rates provided an incentive for countries, individuals, and corporations to take on a ton of debt. There's more information about this topic in a 2-hour conversation that's available on Twitter. You can find this link here on our feed, on Tone's feed here, or the feed of the Financial Summit. The concept of a secular breakout in interest rates aligns nicely with this chart of stocks versus bonds dated September 13th, 2023. This is basically SPY divided by TLT, holding a bullish breakout, favoring stocks over bonds from a consolidation period that lasted 22 years. More information on that topic can be found in the June 23rd video. Technical analysis is about subtle shifts in human behavior. These are very long-term, monthly, anchored volume-weighted average price lines that go back years. See the tone of the market changed here, and the conviction of buyers was not strong enough for price to make a stand at the anchored VWAP band. Same can be said for this hot knife through butter look during the financial crisis. After the March 2009 low, rather than slashing through or being rejected here, there's a battle that takes place. Subtle shift number one, and more importantly, the market eventually breaks out to the upside and then successfully retests that breakout in 2011. And notice the tight cluster of the long-term anchored volume-weighted average price lines in that area. Very similar to a convergence of trends look if we were using standard moving averages. And once the S&P 500 went on to exceed this high, this told us to be open to much better than expected outcomes. So tight band, change of character should get our attention. This is really setting the table for the secular bull market that we're in now. This opens the door to exceed this high from 2008 and this high from the year 2000. And eventually, we do that in calendar year 2013. Thus, from an analysis perspective, we want to establish reference points from this point here, because these reference points can help us when the market pulls back in the future. It's probably fair to say this tight look here and change of character look here is similar to this breakout above a very tight anchored volume weighted average price band that occurred very, very recently, May 15th, 2023. And in terms of the weight of the evidence, it was shifting everywhere in mid-May of 2023, which prompted these Seeking Alpha articles here dated between May 18th and June 7th. Change in character here in 2011. You can make an argument that this is a change in character here. Let's zoom in and talk about that. First, we have a convergence of anchored volume-weighted average price lines from above, tied to the 2022 high up here, below the October 2022 low down here, and years in the rearview mirror. And our primary area of major support here is based on this high here in 2022 and this low in October of last year. Thus, it's very easy to hold positions if the S&P 500 can remain above 4,200 to about 4,110 here, the line tied to the October low. Notice here, when price makes a stand and there's a change of character, there's also a change in character in the trend. The trend here is much stronger than the uptrend here. Thus far, something similar has happened. This move here from A to B shows a lot more buying conviction relative to this move from A to B. And thus far, any volatility that we've seen appears to be a normal pullback within the context of an existing uptrend. The probabilities will begin to shift a little bit if price can get down into this area here. As we noted earlier, a lot of things started to change in a constructive and positive manner walking forward from May 15th, this point here. And when we have improvement converging on multiple time frames, that's what prompted us to use the word opportunity. And volatility tends to distract market participants. Volatility, yes. Is the market considerably higher than it was in mid-May? It is. So we really haven't seen anything to discount all of this. And the next set of charts that we're going to cover from mid to late May align with this concept. These are charts that we covered in the May 26th video. There's no question there's an observable shift in human behavior on XLK divided by IEF on May 25th, 2023. The ratio is holding the breakout. Very similar comments here. Broad U.S. stock market divided by IEI. This was a favorable, be open to better than expected outcomes setup. Chart dated May 25th. You may remember in the May 26th video, we talked about the subtle flip. Q1 of 2023. Black, the slowest moving average, the 250-day, is on top and the slope is down. Contrast that with the much improved look on this May 25th, 2023 chart, where the slowest moving average of the 250-day in black is now on the bottom and the slope was turning up. And since May 25th, the S&P 500's done a nice job holding on to gains. This is the S&P 1500. Had this similar and constructive setup on SPY, the S&P 500 divided by SHY. Thus, we haven't seen anything this week that contradicts the secular trend thesis. And we could provide several examples of new developments. So weekly chart of the VIX, the volatility index. We're looking at all the data that we have for the present day VIX. Only 2 times in the history of the VIX have we shot up into the 60s on a fear spike and then eventually worked our way down to the lower green line. The first example, between 2008, 2009, and early 2013. Second example, the COVID peak here. From that peak, it's taken us this long to move back down to this same level. So we move from A to B and A to B. This chart is dated September 14th. And if we look at this period in this context, by zooming in, here's the change in character look, the convergence of the long-term anchored volume-weighted average price lines. Buyers step in with conviction, and eventually we exceed this high here from 2011. And then the VIX completes the move from point A to point B, which is very, very similar to the A to B move we just completed in September of 2023, as price is exceeding this high here. So does this type of move in the VIX align with or contradict the theory that this May 25th breakout was significant? Does it align with or contradict all of the constructive evidence covered in these posts? Does it align with or contradict the theory that this tight cluster breakout is also relevant? To answer that question, let's ask and answer another question. How did the stock market perform after this A to B move? From January 18th, 2013, which is similar to September of 2023, the A to B move was very satisfying. From this point here to this point here in 2015, the S&P 500 tacked on an additional 43%, simply telling us to keep an open mind about better than expected outcomes, much better than expected outcomes over the next 1 to 3 years. Markets are about human behavior. Humans are extremely concerned here in 2009, and then slowly they become more confident about future economic outcomes when the VIX gets down to this level here in January of 2013. Market participants are extremely concerned near the COVID low in 2020, and they slowly start to gain confidence again by the time we reach the same area inside the green box. So if you're skeptical, that's how you're supposed to feel. Plenty of skeptics still around here in 2013, and yet good things happen for a long period of time. So from an opportunity cost perspective, hypothetically, what could a 43.39% gain mean? If you have a $2 million portfolio on January 18th, 2013, hypothetically, when we hit this peak here in 2015, May of 2015, your $2 million, hypothetically, would be worth somewhere in the neighborhood of $2.8 million. Same hypothetical move if we start with $3 million, over $4 million. If you're a relatively new client and we still have some money in the money market, this is a good baby step here. Anchored volume weighted average price. This is the recent high at the end of July, early August. Trying to recapture that line. A good next step would be for the S&P 500 to exceed this high here. Not done that yet as of September 14th. That may or may not happen. It's just a good short-term reference point. So far, the tight cluster of VWAPs in here, near May 15th, 2023, so far, prices made a stand above those levels, somewhere in the neighborhood of 43.35-ish. The band of support, lower end of it's tied to the October low, the strongest band, around 4065. I think it's probably fair to say the very rare move, something that just happened that we can see, measure, and put in a model in the VIX, aligns with the concept of a secular trend. Same thing can be said for the MOVE index, which is often called the VIX for interest rates or the VIX for the bond market. The standard VIX, $VIX, was at high levels, has come down considerably. Same thing could be said for the MOVE index. In March, it almost hit 200. During the debt ceiling talks, around 145. At the close Thursday, significantly lower. Not at 200, not at 145. It closed at 97 and change and printed a new 52-week low. This aligns with this, and this. The four charts on your screen are covered in detail in this short takes post. You can find it by Googling the title on your screen. No paywall, no need to log in. And if we look at an updated version of this chart here, so far so good. Came into the cluster here, got out of the cluster, came back, tagged the cluster, and are trying to move higher. Like the S&P 500, a good baby step would be to exceed this high here and start to move away from the band, which is what the S&P 500 did in mid-May. Two themes that we will most likely be driving home in these videos as long as the secular trend thesis holds water. Theme number one, secular trend does not mean easy. The 1987 crash occurs within the context of a secular trend. The COVID crash occurs within the context of a secular trend. The 1990 recession occurs within the context of a secular trend. Major point number two, especially in an environment with higher inflation and a bias towards higher rates over the long term. If we have a secular uptrend in interest rates, it doesn't mean that interest rates go up every week, every month, every quarter, or even every year. There's going to be counter-trend moves in any long-term uptrend. And if we're going to try to navigate between a point A and a point B that could be several years down the road, if we want to have satisfying returns up here, in this type of environment, the new world, higher rates, higher inflation, probably going to have to withstand larger drawdowns than we're typically comfortable with. But conceptually, if you were able to navigate from this point A down here to this point B up here, did these drawdowns really matter? And as we said before, it doesn't mean you throw risk management out the window. You just have to make some adjustments to your trend following strategy. Price took a page right out of the secular trend playbook in recent months. Earnings estimates, they're rising. The most relevant economic data. Shaded areas are recessions. So 1 year chart, new high. 1 year chart, new high. Still strong. The larger chart is real personal income excluding current transfer receipts. Total non-farm payrolls. If we zoom in on this portion of the chart, go back 1 year, this is the data set. Same can be said for the household survey, which is in this list here. Some weakness in manufacturing and trade industry sales, but this really doesn't look like this. And this tell us we should be open to manufacturing improving in the coming months. Financial conditions, tighter, yes. Extremely tight, no. Again, more about that topic, which ties in nicely to this topic that's talked about on this recording. If we zoom in on this chart, It's not particularly shocking that the height of credit tightening occurred on Friday, October 7th, 2022. Since then, credit conditions have been steadily improving. This chart's dated September 8th. It's the latest data that they had on Fred this week. Same can be said for this chart of credit spreads that remain tame. This aligns with this, it aligns with this, and it aligns with this A to B move here. And last time that happened, good things happened for a long period of time. And another data set related to the VIX that we've covered in the past, the VIX during Thursday's session trading at 1304, below 14. Context of a secular trend here, context of a secular trend here, and regardless, Mark's work tells us to keep an open mind about lower volatility and stronger trends and better than expected outcomes that could last well over a year. The 1992 window occurred with price action taking a page from the secular trend playbook. And price action here looks very, very similar to price action, or more importantly, human behavior here and here. In this period here, either late 2011 or in 2012, walking forward, price action looked a lot like a secular trend. Price above an upward sloping 200-week moving average in blue. It's very important that we continue to walk forward with a balanced approach and an open mind. We can't just think about positive outcomes. That's what a chart like this helps us with. If the observable evidence shifts in a meaningful way, we'll have to reassess the probabilities. This is what defensive staples XLP divided by SPY looks like when fear is increasing. Here's the stock market falling. Fear is increasing. The stock market is falling. Fear is increasing. The stock market is falling. From a trend perspective, and the fact that we're below a downward sloping 200-week in red, same ratio, September 13th. This really doesn't look like this. It really doesn't look like this. Nor does it look like this as the market rolls over in 2007. In fact, this, for the most part, is the polar opposite of this. It's probably fair to say that the ratio high-yield bonds relative to 3 to 7 year treasuries, so that's JNK divided by IEI in the ETF world, it's probably fair to say that this is a discernible shift. It really doesn't look anything like this 1.5 to 3 year period in here that's marked by a lot of volatility and indecisiveness. Last year, the ratio had blue, the fastest moving average, on the bottom, and during the year, black, the slowest moving average, was on the top, and the slope was down. This really doesn't look anything like this. Blue, the fastest moving average, is on top. Black, the slowest moving average, is on the bottom. The slopes of all the moving averages are up, and price is above all of the moving averages. As of Thursday's close, this weekly version of the same ratio was up 0.43%. Look at this chart. Think about what it means. JNK kicks off a higher yield relative to IEI, and then think about the question at the top of your screen. The next set of charts. Does it seem to align with or contradict the concept of longer-term opportunity? September 14th, the turn in 2023 here doesn't really look anything like the turn in 2022. Doesn't really look anything like the negative turn in 2008, nor the negative turn here in Q4 of the year 2000. And in fact, 2023 here looks a lot like this positive turn after the dot-com bust bear market was OVER and after the major low in October of 2002 and the successful retest in 2003, with price above a moving average envelope that's turning up. Price above a moving average envelope that's turning up. This aligns with this NASDAQ 100 signal that's covered in detail on short takes. You can find short takes by Googling our last name and short takes. Still have a constructive momentum turn on the NASDAQ 100. It's only happened a handful of times in the NASDAQ 100's history. It's probably fair to say that these green numbers out here tend to align with this recent move in the VIX and the concept of a secular trend that could produce impressive gains for years to come. Impressive gains for years to come. Impressive gains for years to come. There's a wealth of information about demographics in the context of 2023 on our website. You can Google the title on your screen and our last name, Shavako. If you're interested in learning more about possibly working with Shavako Capital, there is a wealth of information on our website. Notice the improvement in risk appetite from mid-May, where the cursor's flashing, and September 13th of 2023. That's on one time frame. This is on a significantly longer time frame. While the bulls have made some progress relative to wrestling back the short-term trend, they still have work to do. Given the S&P 500 is basically flat this week, down approximately 7 points, all of the bullet points from last week's video, all of the concepts from last week's close, they still apply. Bullet point number 1 seems to be pretty high on the list of potential concerns, things that have not happened yet, but that we should be aware of and that we should respect. But the weight of the evidence tells us that the odds of the market exceeding this high here are much greater in the coming weeks and months, based on what we know today, relative to the market exceeding the October 2022 low. And uptrends, by definition, make a series of higher highs and higher lows. And we all know, if we're going to try to successfully navigate from a point A to a point B that could be several years down the road, it's important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.